When a stock is trading near absolute all-time highs with a massive price-to-earnings ratio, you have to ask yourself, is it a runaway freight train you need to jump on or, a towering value trap just waiting to collapse?
Right. That is the defining tension of the entire market right now.
Exactly. And before we get started, please like the video and subscribe to our YouTube channel. And it's basically compulsory that you leave comments and feedback down below. We really want to hear your thoughts.
Yeah, definitely let us know what you think. It helps a lot.
So you, the listener, are looking at advanced micro devices today, AMD. As of April 17th, 2026, it's trading at a blistering $278.39.
Which is pretty crazy because it's fresh off a 52-week high of $281.05. And the 52-week low is, well, miles in the rearview mirror at this point.
Yeah, it really is. We've got a massive stack of sources today. We're going to cover the news, stock quote history, and exactly who is buying and selling right now.
Plus, we're digging into the technical analysis, some really interesting momentum indicators, and the latest analyst ratings, too.
Right. So our mission is to unpack AMD's record-breaking 2025 financials, analyze those technical signals, and really debate whether this AI darling is truly undervalued or a retail trap. Okay, let's unpack this.
I'm ready. Where do we start?
Before looking at where the stock is going, we really have to look at the engine driving the car, the financials. We're looking at the income statement, going through both the quarterly and annual numbers.
And those numbers are staggering for fiscal year 2025. I mean, total revenue hit $34.64 billion.
Wow.
Yeah, that's up 34% year over year.
Yeah.
We aren't talking about some nimble startup doubling tiny revenue. This is a massive legacy tech giant.
Right. Moving the needle by a third in 12 months is huge. And their net income sits at $4.34 billion with an operating income of $3.74 billion.
But the metric that really matters here, the one showing their actual leverage, is the gross margin. It expanded from 54% in 2024 to 57% in 2025.
3% margin expansion in hardware manufacturing. That's like phenomenally difficult to do.
Exactly. You don't just stumble into 3% more margin. It means they either have way cheaper fabrication costs or they just have incredible pricing power.
Well, let's look at the rest of the fundamentals before we debate that pricing power. Let's cover the balance sheet and cash flow.
Sure. The balance sheet is practically a fortress. They have $76.93 billion in total assets against only $13.93 billion in liabilities.
That's a massive cushion.
It is. And they're sitting on over $10.5 billion in cash and short-term investments. Plus, the operating cash flow is a very healthy $7.71 billion.
So it basically sounds like a corporate fortress with this massive moat of cash. But wait, if they have $7.71 billion in operating cash flow, why is everyone so obsessed with their stock price relative to these earnings?
Because the market doesn't just buy the present reality, it buys the future narrative.
Right. And for you listening, think about how often a company with these solid fundamentals still feels like a really risky bet when you go to buy the stock.
That's the disconnect, right? The solid financials explain a strong company, but we need to look at the technical analysis and the latest news to explain the market's aggressive behavior.
Yeah, let's discuss the trend direction, because the stock is in this incredibly strong uptrend.
It's trading way above its key support and resistance levels. The long-term moving averages are totally left behind.
Right. The 50-day simple moving average is way down at $212.13, and the 200-day is at $202.45.
And with the current price around $278, the momentum is just undeniable. In fact, the MACD indicator is flashing a solid buy.
And here's where it gets really interesting. There's a massive red flag flashing on the charts regarding short-term weakness.
You're talking about the RSI?
Yes, the relative strength index.
Yeah.
Our sources show it sitting at 72.11, and it's spiked up to 80.2. It is in extreme overbought territory.
Which is the psychological exhaustion point. At an RSI of 80, algorithmic models start flagging the asset as highly vulnerable to a pullback.
So the buying pressure has basically exhausted itself. But let's talk about the order flow, who is actually buying and selling.
This is critical. Order flow data shows heavy smart money accumulation way down in the $200 to $220 range. The institutions loaded up down there.
Wait, really? So if the smart money loaded up at 210 and retail traders are buying the hype of the $281 all-time high, are retail investors just providing exit liquidity for the institutions?
That is the fear. When sentiment is this greedy, institutions use the retail frenzy to quietly distribute their shares and lock in profits.
So retail gets caught holding the bag if the stock corrects back down to its moving averages.
Exactly. And this fear of buying at the top leads us directly into the biggest debate right now. Valuation. Is this undervalued growth or a terrifying value trap?
Let's do a reality check on those ratings and signals. We have to talk about the PE ratio. The trailing 12 months PE is sitting at a dizzying 106.26.
A PE of 106 basically means the market is pricing in absolute perfection for the next 10 years.
But the intrinsic value of the company, if you just look at their legacy business, the standard gaming and enterprise chips analysts peg that fair value at just $101 to $130 a share.
Right, and this raises an important question. If we connect this to the bigger picture, everything from $130 up to $278 is pure AI premium. It's the market pricing in years of flawless future growth.
It's paying for an AI dream that hasn't fully materialized yet. But despite that crazy PE and those negative signals on the RSI, the analyst consensus is still a moderate buy.
Yeah, analysts are all over the place. Some say sell, some say strong buy, some say hold, but the average price target is
Though
$291.52.
the range is huge, the lowest target is $220, and there's a wildly bullish target of $365.
What's really telling, though, is the short interest. It's only 2.25% of the float,
Meaning almost no one is brave enough to actually bet against them right now, even with the technical red flags.
because shorting a hype train can bankrupt you. But to justify that massive AI premium, we need to outline the best-case recovery scenario against the worst-case continuation lower. Let's look at the bull versus bear case.
Okay, I'll champion the bull case. The upside is insane. Their data center revenue alone was a record $16.6 billion in 2025.
That segment alone is the size of a Fortune 500 company.
Exactly. And their EPYC CPUs have likely crossed a 40% market share. But the absolute crown jewel of the bull case is this landmark partnership. They are deploying 6 gigawatts of AMD Instinct GPUs into OpenAI's infrastructure.
We really need to pause on that. 6 gigawatts is almost sci-fi. A massive enterprise data center usually runs on maybe 20 to 50 megawatts.
So 1 gigawatt is 1,000 megawatts.
Yeah, so 6 gigawatts is roughly the power output of 6 nuclear reactors.
Mhm.
Dedicating that entirely to AMD's AI chips for OpenAI is an unfathomable scale of infrastructure.
It's the ultimate validation. If OpenAI trusts them at that scale, AMD is foundational to the AI era. That's the best case scenario that pushes the stock to 365.
It is. But I have to bring the calm voice of reason here for the bear case. Explain the downside risks, the volatility, and why retail traders often get trapped.
Go for it.
A PE over 100 means any slight miss in future guidance, any delay in that 6 gigawatt build-out could cause a massive, violent drop.
Because there's zero margin for error priced in.
Exactly. Plus, Nvidia still heavily dominates the AI software ecosystem. Their CUDA software is deeply entrenched.
AMD has ROCm, right, to compete with CUDA.
They do, but switching a whole engineering department from CUD to ROCm causes massive friction. Nvidia's software moat is incredibly hard to break.
Yeah, and there's another thing from the sources that caught my eye. AMD has planned 10 to 15% price hikes on their CPUs.
Which is a very tricky signal to read.
Right, like is that pricing power, meaning they can just charge whatever they want? Or is it a red flag signaling tightening margins and they're just passing supply chain constraints onto the consumer?
This raises an important question. Can AMD maintain its massive growth without passing so much cost onto the consumer that their chips become less attractive?
If they do, that upgrade cycle slows down and that 106 PE suddenly looks incredibly dangerous.
Which brings us to the outlook. Balancing these incredible AI tailwinds against the stretched valuation, what is the actual perspective for the listener? Let's break it into short-term versus long-term.
Let's start short term, next few weeks.
Due to the extreme greed in market sentiment and that RSI above 80 we talked about, the short-term outlook suggests potential sideways consolidation or even a minor dip.
So a period of short-term weakness while the moving averages catch up to the price.
Yeah, it needs to cool off. But the medium to long-term horizon, it's bullish, but with a terrifying mathematical caveat.
Okay, what's the caveat?
To justify this valuation and hit their goal of a $100 billion annual data center business, AMD must achieve a massive 35% compound annual growth rate in revenue.
35% compounding every year. When they already make $34 billion, that is a monumental task.
It basically defies the law of large numbers. They have to execute flawlessly.
So what does this all mean for you, the listener? Well, the next major catalyst is right around the corner. The quarterly earnings report is on May 5th, 2026.
That call is the moment of truth. The market will demand proof that this 35% compounding growth is happening. If management hesitates at all, that AI premium will vanish.
Let's briefly recap all of this. You are looking at a fundamentally elite company, right? Massive cash flow, 52-week highs, expanding margins.
But it has an eye-watering valuation.
Exactly. It's driven by this 6-gigawatt OpenAI deal, but it's facing fierce competition from Nvidia and massive expectations. It's the classic undervalued versus trapped debate.
And I want to leave the listener with a final thought to mull over, kind of an uncertainty to end on.
Hit me with a cliffhanger question.
We know the core non-AI business is valued around $101 to $130.
Yeah.
The rest is the AI dream. So if we strip away the AI hype from the broader market entirely, how many of the market's current all-time highs are built on a foundation of present reality?
Wow.
And how many are built solely on an AI future that hasn't actually been built yet?
That is the million-dollar question. Make sure you keep digging into your own research, watch those support levels, and brace yourself for the May 5th earnings call. Remember, this is just a deep dive, no financial advice here.
Thanks for listening.
Catch you next time.